Hello, and welcome to Homeowner AF, the Canadian first-time homebuying podcast. I'm Brianna Goslin, mortgage agent level 2, and I work with Canadian first-time homebuyers every single day. If you want to own real estate in Canada but aren't sure how to position yourself to get there, this is the podcast for you. I want to see more young Canadians in the market, building equity and long-term wealth. That starts with getting the right advice at the right time, so you're positioned to act when it matters. Each week, I'll bring you bite-sized episodes that actually move the needle toward homeownership. Short, strategic, and packed with practical tips that you can use right away. I'll cover topics like minimum down payment, closing costs, credit, co-signers, and more. Remember, your finances are like a thumbprint. No two are the same. For advice tailored specifically to you, book your free call at briecallme.com. Now, let's get into it. Hello, welcome to Homeowner AF, the Canadian first-time homebuying podcast. Today, I am walking you through the 30-year amortization. And if you've had questions about whether you should opt for a 25-year or 30-year amortization for your first home purchase, this is the episode for you. I'm going to run through the pros, the cons of a 30-year amortization, as well as a strategy that can allow you to have the lower payment of that longer loan length while also keeping it in line to pay it off quicker. So stay tuned till the end of the episode. I will give you a tool that will help you with that as well. But right now, I'm going to explain a little bit about what the 30-year amortization is. So typically, when you're signing on for a conventional mortgage, it's going to be a 25-year loan. And for first-time homebuyers who have a minimum down payment between 5 and 20% for a purchase under $1.5 million, then they previously had been required to have a 25-year loan length, whereas other borrowers who maybe had 30 or 20% down or more could access that longer loan length. Now, in 2024, the Canadian government came out with new legislation that allowed first-time homebuyers specifically to have an insured purchase, so 5 to 20% down, and couple that with a 25 or 30-year amortization, which lengthens out the loan. And what it was supposed to do is increase the amount of first-time homebuyers who could enter the market because affordability would increase a little bit. Now, for this podcast purpose, I'm talking about first-time homebuyers who have a minimum down payment, so 5 to 20% down, who are contemplating taking on a 30-year amortization. If this is not you, if you are a move-up buyer, or if you are looking to purchase with more than 20% down, then this information and this advice will not apply to you. And the best way to get the advice that does apply to you is to run your numbers with me on a free call. Go ahead and book your virtual call at www.briecallme.com. I'm happy to help you and look at what this means for your specific situation. But if you are a first-time homebuyer who has a minimum down payment in mind and thinking about a 30-year amortization, this is for you. I'm going to walk through the pros, cons, and also what you can do to have the best of both worlds. And we love that. So first of all, let's talk about why somebody would opt for a 30-year amortization versus 25 years in this year of 2026. So firstly, it gives you a lower monthly payment, which makes things more affordable in the short term. We're stretching out that loan 5 extra years, which means that the required payment will be lower and your cash flow will increase. This, of course, translates to increased borrowing power, which means that you're going to be able to buy more house on a 30-year amortization. Now, because the stress test is actually looking at the payment, a lower payment will mean a higher qualification for you. And for this reason, that's why it is necessary for some first-time homebuyers to have that 30-year loan length, whether they want to or not, just to be able to break into the market. Flexibility is another thing. You're not locked into 30 years of that same payment. And that sounds kind of convoluted because you are locked in if you're on an fixed interest rate, but prepayment privilege also comes into play. We're going to talk about that a little bit later when I give you that strategy that's going to keep your loan length in line with either 25 years, 20 years, even 15 years if you want it. More about that later. The last pro that I'm going to talk about is a really big one. It's hard to quantify, but mentally and emotionally, it's huge for first-time home buyers. And it's some breathing room, at least for the interim. When we take on a home loan, we're not just taking on a mortgage, we're taking on the cost of home ownership. So up front, that could be some renovations to make the home livable to your standards. It could mean that this is the first time that you're paying utilities. Maybe you were living with mom and dad, or maybe you were paying a rent payment that everything was all in. Those are costs that you're going to have to adjust for, budget for, and get used to. That 30-year amortization may lower payments enough so that you can actually be ready for all those increased costs and you can absorb it. It's not going to put you into debt. You're not going to have to dip into your savings, into your 3 to 6 month emergency fund, or use credit to be able to bridge those gaps. Now, let's talk about the cons because, of course, there's nothing that comes just for free. And this 30-year amortization, it is going to cost you more than that 25-year loan length. So, first of all, we've got the more interest paid over the life of the loan. Of course, stretching out your payments means that you're going to be paying more total interest, especially in those earlier years. You'll look at your amortization schedule and it could take your breath away how much interest you're paying versus principal. Of course, as your loan matures, you're going to be paying more to principal, less to interest, but in the first 5 years, it is quite hefty, the amount of interest that you're going to pay. Of course, it changes depending on what your principal is as well as what your interest rate is. So if you want to know those specific numbers, go ahead and book your call at www.briecallme.com. We can run through those easily. Next thing is slower equity buildup. So less of each payment is going to principal, which means that you are not building up your equity as quickly as somebody who is on a shorter loan length. This is important for those who may want to refinance in the next few years or access that equity. Or if you're looking to move up, so if you're looking to sell your current home, move up to a larger home, and use that amount of equity as your down payment, you'll have to be cognizant of whether you are on a 25-year or 30-year loan length. Costs more to insure is another con. We've talked about the CMHC insurance premium, or you may be using one of the other mortgage insurers, but they apply a surcharge on that 30-year option. So the mortgage insurance itself is going to be more expensive, and we're going to be cognizant of that when it comes to closing day, because part of your closing cost is going to be the tax on that mortgage insurance, which some folks do miss, and you want to make sure that you're accounting for that so you're not short funds on closing day. It also takes longer to pay off, of course. You got a 30-year mortgage or you got a 25-year mortgage. That's going to make a difference in those last 5 years of the mortgage loan. In my opinion, also, another con that's not really, again, quantifiable, but the 30-year amortization sometimes can encourage folks who can't afford it to buy more house than they should. Again, just because it's available to you doesn't mean it's a good choice for you. So you want to make sure that you're looking at your budget, you're looking at your carrying costs of that home and thinking, does this make sense to me? If it does, the numbers often speak the truth. They tell you what you need to know, and we can run those numbers quite easily on a call. So go ahead and book in if you want to learn more about that. Now, let's talk about this strategy, what you can do to have the best of both worlds, that lower monthly payment as well as a timeline that is just as short or shorter than those who have signed on to a 25-year loan length without a plan. It's always better with a plan, right? So because so many first-time home buyers are in a season of accelerating their income, so whether you've just signed on for your first full-time job or as you progress in your career, you're going to get raises, you're going to maybe change employment for a better rate of pay, or you have access to some bonuses and incentive pay, that all increases your household income. And typically when you first sign on for your mortgage, you may be earning a little bit less. So it's often advisable to take the lower monthly payment or biweekly payment to begin with, coupled with a plan to pay your mortgage down faster or more aggressively once your cash flow increases. And once the upfront obligations of renovations and repairs no longer is there. So we can talk about this plan at the time of arranging your mortgage, or we can book a call 3 to 6 months into your home ownership, so that then we can know what everything is costing you, know what you're shelling out monthly, and then also put into action a plan that's going to help you pay off that loan faster. So what is it? It's actually so simple, guys. It's so simple. First thing is you're going to download my mortgage app. So you can go to the show notes. I've put the Canadian mortgage app in there. You can download it using my link and play around with an increased monthly payment, or with paying lump sum payments onto your mortgage principal. Once you have kind of those numbers, say you know that you're going to make $5,000 in December because you have a big bonus coming up. That's fantastic. Run the numbers, see what that looks like, see how much time that's going to take off your loan. Also, you're going to want to make sure that that prepayment or that lump sum payment falls within the 15 or 20% prepayment privilege that you have with your lender, and you can check your mortgage commitment or call me if you're not sure what you have access to in terms of prepayment. But you also want to let your broker know that this is something that you might want to do, because not all self-serve portals are created the same. And there are some lenders who don't offer a self-serve portal. I always recommend going with a lender who's going to offer a great prepayment privilege between 15 and 20%, and a self-serve portal that's going to make it easy for you to either dump some money onto that principal in a lump sum payment, or increase those monthly or biweekly payments as it makes sense for you, your family, and your cash flow. So the next step, if you want to talk real numbers and you want to see what a 30-year amortization or a 25-year amortization means for you when you're signing on to your first mortgage, then you can absolutely book a call at brecallme.com. Please download my mortgage app, play around with that mortgage calculator. And if you have any questions, go ahead, email me, DM me. I'm happy to chat. Any mortgage questions, home buying questions, I'm all ears. And I will be in your earbuds next week with another episode of Homeowner AF. Take care, guys. Thanks for listening to Homeowner AF, the Canadian first-time home buying podcast. You'll find links to everything I mentioned in today's episode in the show notes, along with details on how to connect with me. I welcome all of your first-time home buying questions. Send me a voice note to have your question featured on air. And if you're ready to talk through specifics for your first home purchase, you can book a free call at brecallme.com. Remember, if home ownership is your goal, you could be closer than you think. You just need the right information to make the right move. I'll be back next week with another tidbit to help you get there.